For this first year, the banks are supposed to increase their capital by 2 billion, and there is indeed a number of banks that are below that. We have written to the banks to tell us about what their plan is to raise their capital all the way to the 10 billion, not just for the first year, but to the 10 billion. So we will be engaging the banks once we get the responses from the banks to see exactly how they are going to meet the capital requirements for this year, as well as over the medium term, over the next 5 years.
The second batch of questions will begin with Brian Goge from the Standard newspaper. Brian asks, actually they're related questions again. So how is the CBK conducting inspections to ensure that the banks implement the risk-based credit pricing model, and how many officers have been dispatched? Similar question from Jimmy Mbogo of Citizen. CBK says it has started physical inspection of banks. What prompted this action? How long has it been going on, and what have the results been so far? On a different matter, from Stella Stoakay of Standard Investment Bank, will the Central Bank of Kenya continue injecting liquidity to banks through reserve repos, and how will it ensure that the money actually trickles down to the private sector? Eric Mokaya and Douglas Monene. Eric is from Mwango Capital, Douglas is from DTB. Same question, how much liquidity will be released to commercial banks by the 100 basis point cut in the cash reserve ratio?
Okay, I think the question from Brian and Jimmy Mbogo are somewhat similar. As I said, we have started with the on-site inspections. I think we have staff now working on the. We've started with the 5 banks, and that should be completed within the next 2 weeks or so. Nobody has been fined yet. Obviously, we have to wait and see the results. But I think just to add that in the Business Laws Amendment Act that was enacted by Parliament just the other day, we have provided for penalties for non-compliance with the guidelines from the central bank. And I think in moving away from the capping of interest rates and coming up with this banking sector charter that we all agreed. In that charter, we also provided for remedial measures in the event that banks did not comply with the Banking Act, but also with that charter. And so legally, and what was amended in the Business Laws Amendment Act was to provide for penalties in the event that a bank benefits unfairly or by ignoring the guidelines from the central bank. So that is what we'll be using. Penalties have also been increased from 2 million to 20 million, and there's a provision now to charge the banks by to the penalty to be 3 times how much the individual banks have benefited by. So if they benefit by 100 million shillings, they will be fined 3 times that, which is 300 million shillings. There's a question here about whether we'll continue to inject liquidity to banks through reverse repos. Again, we have a monetary policy implementation framework, and for example, now immediately the CBR has now been lowered to 10.75. So immediately we will be now doing the monetary operations. In this case, we will be to inject a bit more liquidity into the system in order to lower the interbank rate to 10.75. So yes, reverse repos and other monetary instruments will continue to be used in order to align the interbank rate to the CBR going forward.